Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlet Fu. We're counting you down to the closing bell, and here to help take us beyond the bell, it's a global simulcast. Tim Stenovec is here. Katie Greifeld is here. Carol Massar, nowhere to be found. We welcome our audiences across Bloomberg Television, Radio, as well as on Quick Take and YouTube. Tim, a pretty interesting day here. I mean, I don't know how much you could read into the price action, but stocks are significantly higher here on the day, about 1% across the board.
Yeah, we just posed that question to Jake Jolly over at BNY Mellon Investment Management. He's senior investment strategist there, and I said, "Hey, what about this rally?" He's like, "Yeah, I just saw that. He was in our studio right here." He couldn't explain what's going on, but what he did say is be a little cautious ahead of those CPI numbers. And although we got a softer than expected number last month that ended up causing a surge in U.S. equities, he reminded us that we've been disappointed in the past.
The biggest post-CPI surge ever.
Right, but he said he reminded us that we've been disappointed in the past ahead of CPI. So proceed with caution.
And I will say it is interesting that if you look at what volume is doing, we had been trending lower on volume throughout the day. But with this late surge, we're looking at 1.4% on the S&P 500 right now. Actually, volume is just a hair higher than its 20-day average. So this is coming on some actual healthy buying here.
Some healthy buying, yeah, which surprised me because there's so much going on this week. It feels like once we get past CPI, once we get past the Fed, is everyone just done for the year? Yeah. I mean, you know,
the last week that matters.
Yeah, I'm taking off on starting Thursday.
But Romaine, you are going to be back with us before the end of the year.
Oh, I am?
Yeah, just reminding you, it's not. You're not going on vacation for the rest of the year.
Can we still
That's
do
not
that?
allowed.
I'm sorry.
Okay. All right. Well, we're going to find out. I think really, I mean, in all seriousness, I think the next 36, 48 hours really going to be pivotal for this market. And I think to Scarlett's point, going to be pivotal to determine whether anybody actually decides to trade post-Fed here. At least on this day here, Dow Jones Industrial Average higher by about 1.6%. The S&P higher by 1.4%, while the NASDAQ higher by about 1.2%. I do want to point out the Russell 2000 is closing higher by about 1.2% as well. And Dow Transports actually rallied 3% here on the day. And I do want to point out they actually did reclaim that 200-day moving average. So if you are looking at those technical levels, a lot of technical levels that I think will be back in play over the course of this week. At least one of the major averages back above that 200-day.
Well, speaking of technicals, let's talk a little bit about breadth in terms of gainers and decliners today in the S&P 500. Scarlett, we only saw 33 stocks move lower in the S&P, 467 move higher. Romaine's going to get angry when I mention the Dow, but we got to point it out that only one stock, in fact, lower on the Dow, and 29 are higher.
Weighted, or
yeah, we still, price weighted.
Okay,
so yeah, you're still important to me, Dow.
You can't ignore the Dow, but of course we can't really look to the Dow to give us any read into what's going on within the market. So let's go to the S&P 500 and the 24 industry groups there, and you could see pretty much a green day all across the board. The laggard here are auto stocks off by 4.5%. The best performers, transportation, as Romaine mentioned. You definitely see some positioning into cyclicals like the industrials, like the energy stocks, like the material stocks, which show that people are looking ahead, certainly to a Fed pause and eventual pivot. You like how I added that word eventual, Katie?
Eventual. No, that's an important qualification. Before we get to CPI and the Fed, we did have a very robust M&A Monday, Merger Monday, whatever you want to call it. In any case, Thoma Bravo, obviously we all know this story by now. It's buying Coupa in a $6.2 billion deal. You look at what that meant for Coupa shares, just absolutely skyrocketing up 27%. Going down the list, we have Amgen buying Horizon Therapeutics. The company arranged a $28.5 billion bridge credit facility to do that. So pretty big price tag there. You look at what that meant for Horizon, up 15.5% or so. And finally, we do have Weber. Those shares rose over 23%. That's after news that they entered a take-private deal with BDT Capital Partners. That deal values Weber on an equity basis at about $2.3 billion.
All right, let's talk about decliners. Kind of tough to find some notable decliners today. You did mention Horizon Pharma, so I should mention that Amgen did close down about 0.7%. Let's talk Tesla, though. Shares finishing the day down by 6.3%, to it closing at its lowest level since November of 2020. No specific news, at least today, dragging the company lower. But I do wonder to what extent Elon's tweets and concerns about the fact that he's so focused on Twitter are weighing on sentiment at the company. We had a great story by Sean O'Kane last week about what one large individual shareholder said about the board being MIA. Moderna shares down close to 7%, finishing down 6.9% today. Again, can't quite figure out why. Pfizer did come out with earlier in the day saying that mRNA vaccines could give them up to $15 billion in commercial potential by 2030. But that happened midday, and Moderna shares were under pressure before then. And then Netflix shares. Think back to last week when Carol was talking about this day after the stock kept moving higher. It's up nearly 90% since those May lows. A little bit lower today, down 1.5%, Romaine.
All right, okay, a quick look here at what's going on in the yield space. Pretty much higher across the curve, about 3 to 4 basis points right now on the 2-year yield. We should point out we had an interesting auction a little bit earlier today on that 10-year yield and on that 10-year, and it was not good. Basically, the demand just wasn't quite there here. It'll be interesting to see whether that was just an anomaly, given that, of course, it was priced right before a big CPI report and a big Fed report. We get a 30-year auction tomorrow. But overall, we go back to sort of that inversion that we've seen on the yield curve, an inversion that remains. And that really is kind of the story, because this is sort of the look ahead, I think, beyond these rate hikes, beyond peak inflation, what's on the other side. And if it is a recession, and that's what the bond market is pricing in, then I think equities have some repricing that they have to do as well.
But there's always been this split between what equities see and what bonds see. I wonder, when it comes to inflation, how much the New York Fed survey on household inflation expectations really set the tone for today going into CPI. The New York Fed survey showed that people are expecting lower inflation, still inflation, but lower than perhaps what they had projected last time. My question is, how reliable are these household surveys? If someone called you up, Katie, to ask you what you thought inflation would be, would you be able to quantify it?
I don't think I would answer the phone, to be honest. So that would be,
That's a real issue with these surveys.
I know, it is kind of fun to think about.
Who answers them? That's
the
a real
methodology.
issue.
But if you think about the survey-based measure, you think about the market-based measures of inflation expectations. If you look at break-evens, they've all been contained. They've been out of step with the actual data for a while.
And I just want to point out, too, I mean, even if you get away from the consumer, I was looking at the Philadelphia survey of professional forecasters, so, not just people sitting at home on their couch. And their actual expectations going forward are actually in that 2% range, and they're looking primarily at the PCE data.
2%
so
when?
Over a longer term period, so over 5 to 10 years, which is exactly what the Fed wants to see. They want to see those inflation expectations anchored around that 2% level, and they are, and they have been. And I think that if there's any silver lining here, at least for the Fed and what it's trying to do, that maybe might be it.
Well, to go back to Scarlett's question, I think every little bit of information that we get helps inform the trend line here, right? So it goes back to what we got last week with University of Michigan, Scarlett, and the idea that inflation expectations, at least in the short term, came down significantly. So it's every little bit of data, I think, that investors are weighing here. But again, it's kind of the most important thing happens on Wednesday when we hear from Fed Chair Jay Powell.
Well, every little piece of data is what people are focused on. We do have data out of Oracle. Second quarter revenue of $12.28 billion, higher than what analysts had been looking for. The consensus estimate was just over $12 billion. Adjusted EPS also coming in better than expected by 3 cents, $1.21 for the adjusted EPS. Right now, the stock is up about 3% at the moment.
Yeah, and this wasn't really that unexpected. I think the fact that they continue and the idea that business spending has generally held up, particularly for some of these legacy software companies and database companies like Oracle, a good thing. We should point out margins coming in a little bit light here, so a little bit of a squeeze there. And I think that has been a concern going forward, that these companies might still be able to post growth, but whether that margin story that sort of carried these stocks over the last couple of years is going to be there remains in question.
And you see Oracle shares up about 3% post-market, jumping around a lot, but it seems like the trend is higher. The question on margins is a big one. Obviously, you've had a lot of big bears on Wall Street calling for sort of peak margins, that you're going to see that story deteriorate a bit next year, maybe as companies reach peak pricing power.
Everything this year was peak, right?
It was peak. I hope so.
Peak?
The trough.
Is it though, or does it stay there for a while?
Well, to that point, Jake Jolly just a few minutes ago said that we're not seeing a trough, Scarlett, when it comes to equities that's consistent with what we'd see in a recession.
Can I just point out, though, I mean, CPI is supposed year over year is still coming in at 7.3%. At least that's the consensus estimate. 7%.
That's hot.
Well, yeah. Why am I supposed to be?
But because it's the trend. It's coming down. It potentially peaked, and that means that
one or whatever.
What does the
and then maybe, but also base
last
effects.
Last time I checked, they had a 2% or 2-ish, right? They sort of changed it, right? A sort of broader target, but we're nowhere near that.
if you think about a Fed that is very, very cautious about over tightening, they don't want to do that. They're paying attention to that trend because it's 7% now, but how quickly it drops to 2%, who really knows?
Exactly. I mean, just because it went up a certain way doesn't mean that the way down mirrors that or is symmetrical in any way. And we haven't really figured out that part of it yet because we haven't seen inflation in so long.
All right.
Well,
All right.
I'm going to cut back spending already to do my part here.
Thank you.
Right ahead of the holidays.
I'm going to keep
No
stimulating the
Christmas gifts this
economy,
year.
so it'll be
Right ahead of the holidays. All right, I'll remember that when I don't get a gift from you, Romaine. That is going to do it for our cross-platform coverage, at least for now. It's the market close on Bloomberg Television, on radio, on YouTube, and of course on Bloomberg Business Week. We're going to be back tomorrow, same time and same place.